Hey, everybody. Welcome to today's workshop. How professionals trade earnings. Do me a favor, would you? Go and hit that Q&A box and let me know you can hear me by saying Zoom. Zoom, 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 zoomy, boom, boom. Alex, thank you. Thank you, thank you, thank you. Vano, thank you, thank you, thank you. Vince, thank you, thank you, thank you. Kazim, thank you, thank you, thank you. Thomas, thank you. Vince, thank you. David, thank you. John, thank you. Adam, thank you. Uh, Callan, thank you. Fawn, thank you. You guys are awesome. All right. So today we're talking about how professionals trade earnings announcement. This is going to be a good one. This is going to be a really, really good one. Get out your pens, your pencils, your paper, your Pound Pilots, whatever it is you use here, and get ready because I got some great stuff to cover. Earnings is one of my favorite things to trade, and the system I use, I'm really proud of. I love trading it. Now, before we get started, I need to point out options are not for everyone. Read characteristics and risks of standardized options before trading. Get a copy of that by emailing investorservices@theocc.com. Don't trade with money you're not prepared to lose. And everything we're covering here is hypothetical and general and not specific to your particular needs, objectives, abilities, etc., etc. Now I've seen some old friends here, but I also saw some new faces. Well, new names. So allow myself to introduce myself. My name is Dan Passarelli, and I am an author of two of the most popular option trading books. Slowly working on my third. Oh my goodness. It's not going to be out for another 10 months, but and I was included in a couple book projects and wrote many articles. I have my own Substack. So oh my gosh, I do a lot of writing. I am a trader. I I started trading when I was in college and ended up trading as a professional down on the floor of the Chicago Board Options Exchange, Chicago Board of Trade, CME Group, all around Chicago. Traded off floor for a small hedge fund and all that kind of stuff. And I still trade in a retail account just like you. And I am the founder and president of Market Taker Mentoring, which is the global leader in option trader education. We have student traders in over 50 countries. We've helped, I don't even know how many, I've lost count, tens of thousands, maybe 100. I mean, including workshops like this that are online, easily over 100,000 student traders. Oh my gosh, that's a lot. And I am a trading industry collaborator. I have worked with Firstrade now for a long time. I work with options friendly brokers, the good ones like Firstrade, and some others as well for a long time. Worked with most of the options exchanges and important options education groups in the world, not just the United States. When China was launching their options, I went there and helped them to develop this capitalistic endeavor we call option trading. And let's see here. I'm a family man, married to my wife, Kathleen, who is in charge of operations here at Market Taker Mentoring. Those of you who are Market Taker students who do some of our classes, you're familiar with Kathleen probably. She sent you an email. Got my two adult children and my two very cute small little dogs. And I do other things for fun besides trading. I like to run. I'm a foodie. traveler, been all over the world, musician, gardening is what I do during the summers sometimes. That's what I've been doing lately. So, yeah, I do lots of stuff besides trading. Now, let's talk about the important person here. Let's talk about you. And let's talk about how you can move your trading forward as possible. Well, in addition to today's class, you can also download this ebook. Go to Market Taker Mentoring /earnings. Market Taker Mentoring /earnings, and get this free guide that supplements everything that we are covering here today. All right, folks, let's jump right in. Earnings season. Earnings season is about to start, like next week, I think, right? Yeah, I mean, that's coming right up, man. And you want to be ready for it, don't you? Well, I'm going to help get you ready for it. Between what we talk about today and that free guide that I just gave you access to, and another online training that I'm doing for market taker students, if you download that guide, you'll get an email about it. We're going to get you ready for earnings season. What am I talking about here? Well, publicly traded U.S. corporations are required by law to announce what they have earned once a quarter. About 75 to 80% of all U.S. companies announce earnings in what we call earnings season, which is basically the end of January into February, end of April into March, end of July into August. Oh my gosh, it is July 8th. How did it become July 8th? It was just New Year's Day like 3 weeks ago, wasn't it? Oh my goodness. But the third quarter earnings season is just about upon us. That's where they announced. Yeah. And then, of course, the end of October into November. So 75 to 85% of companies announce during that cycle. And by the way, that cycle starts, like, I mean, it's really starting next week for the July cycle. And it kind of goes really all the way till like the end of August. It's about 6 weeks of announcements. Yeah. And towards the end of that is what we call the retail earnings season, where, like, you know, your Targets and your Nikes and your you know, Macy's and all that announce. In the not earnings season, that's when the other 20 to 25% announce. So really, this is something that you can trade year round. And here's the deal. So this is a little bit crazy. During earnings season, when a company announces, well, what I should say, let's forget about earnings. When a company announces their quarterly earnings 4 times a year, on that day, that is often one of the biggest moves in the stock price for the entire quarter. So it's a pretty special day. That move is typically somewhat priced into options. What does that even mean? With options, we have something called implied volatility. You remember that from our past workshops here with Firstrade? If you don't remember it, go back and look for, oh, good, John. Look for my workshop on Firstrade's YouTube channel. Just look for, this sort of picture so you can spot which ones are mine and find the one on implied or on volatility in general. Because when markets expect a big move, they tend to buy options, either options for protection to protect against the stock that they own, or to make money on the move, buying a call instead of the stock because there's more risk with the stock, or a put because there's more risk shorting a stock, buy a straddle. So that makes options more expensive when the market collectively believes that there's likely to be a big move in the stock price. So what happens is that sometimes that move is overly priced in, meaning options get too expensive in specifically the short-term expirations. So why is earnings season so important? Well, the Federal Reserve, has two mandates. Like the whole purpose in theory, of their existence is to manage inflation, which has historically been to keep it under 2%, and full employment, which both are a little weird right now. But, hopefully they're trying as best as they can. Now that goes hand in hand with corporate earnings. Because look, earnings is ultimately really what drives the stock market. How many folks out there look at fundamentals when you make your investing decisions? Not necessarily your trading decisions, but your investing decisions. How many folks look at fundamental analysis? Look at your PE ratios, trailing 12 months, forward PE ratios. The E there is earnings. Now, if you don't, that's fine. There's a lot of traders who don't. I spent most of my career not looking at these things. I look at them more now, though, because I do a lot of work with covered calls and cash carried puts, and that kind of helps those. But the whole idea is the reason you buy a stock is to capture those earnings. And so when companies earn more, that drives the price of the stock higher. Right? Because people will pay more if they can get more earnings, which is theoretically you are getting those because theoretically, not theoretically, actually you are an owner of that company. So people look at this stuff and the Fed looks at this stuff. The Fed looks at this stuff because they can take a look and see is there extra hiring going on? Is there extra employment going on? What's going on with the market? Theoretically, the Fed shouldn't care about the market. That is not one of their mandates. Although, Now, the most important thing here is that because of all the things we talked about so far, earnings trading provides unique trading opportunities for option traders. And there are certain things that can be and can't be. First, let's look at the can'ts. We can't know what earnings are going to be in the future. If anyone does know what earnings is going to be in the future without having inside information, like you have a crystal ball, you're psychic, they accidentally delivered tomorrow's newspaper to you today, give me a call. If it's inside information, don't give me a call. I don't want to know. But we can't know the future. We can't know what earnings will be. We also can't know, even if we did know what earnings would be, how the market will react to them. Because here's a little dirty little secret about earnings. And this is not in the presentation. So if you're taking notes, which I highly encourage you to do, this is something to write down or at least remember. Although statistically, you forget like 90, you're going to forget like 90% of what I told you. So maybe try and file this into the 10% folder. Analysts look at companies, and we're talking, analysts who work for major corporations. They look at companies and they say, I think WXYZ company is going to make this many dollars on their next earnings, this many dollars per share on their next earnings. That's what I think they're going to announce. But here's the big secret. Most companies actually outperform what analysts say quarter after quarter for years, for decades. It's been that way. So either analysts are just bad at their jobs, or it's this little game that they play and underestimate. So if a company outperforms what analysts say, the market already knows that that's the game that is played. So if an analyst says, well, we project that WXYZ company is going to make 58 cents a share. And if the company makes 58 cents a share, you know what a lot of times will happen? Stock will go down because they didn't outperform. Weird, right? Not only that, what's more important than what the earnings number is what they say in the conference call that goes along with earnings. They could beat the pants off of earnings. Maybe the analysts say, oh, we think it's going to be 58 cents a share, and it's actually $1.58 a share, way outperforming. But then in the conference call, they say, yes, but we sold out of all of our inventory. That's why it's so high. This is never going to happen again in our company's history. And the factory that makes our inventory burned down. And by the way, the CFO is cooking the books, and we can't, furnish our debt, and we're in a ton of financial trouble. Guess what happens to the stock, even though they beat earnings? Right? So we don't know how the market's really going to react to them. And one thing we definitely don't know is how to predict direction. Can't be done. Can't be done. But what can we do? Well, we can know when earnings announcements will be. Now, you might look at that and say, no joke, Dan. I almost forgot this is a family show and not my own webinar, and said something besides joke, but no joke, Dan. Obviously, we know when earnings are going to be announced. But that's more important than you think, but then we can look at volatility. And one thing we know about how volatility works around earnings is that as we get closer to the earnings date, people tend to buy options for protection, to speculate on them beating earnings, which most companies do, to speculate on them not beating earnings or going down for whatever reason, to buy a straddle because maybe this company, historically moves a lot. And then after earnings, the implied volatility tends to just collapse. So it goes up, up, up. We get a rush of buyers, and then we get the crush of volatility. Because we know when that exact date is, we know when we get to that pinnacle and when that crush happens. This becomes very important news. This becomes a very important thing to perceive, identify, look at, because it is somewhat predictable in my observation. Direction, I cannot predict direction on earnings. You find me one person who says he or she can predict direction on earnings, and I will show you a liar. Can't happen. Predicting volatility, nobody can predict anything with 100% certainty, but you can predict. I believe that it is possible to predict volatility, not with 100% certainty, but with a pretty high degree of certainty. And I think my system proves that. So there are several advantages to earnings trades because we're trading only volatility and not direction. It's market independent. I don't care if the stock goes up or down. Don't care. Doesn't matter. It's also very short term on each trade. So I also don't care if the S&P 500 is going up or down. So I have limited broad market exposure. There is some correlation between how stocks trade on an earnings day and what the market does, but less than a typical day. There are also potentially greatly leveraged profits. We don't make money on every single trade, but the trades that work out great can work out great. I've made 50% overnight on a trade, 40%, 30 some percent, a lot more common, 20 some percent, pretty usual. In the tens and teens, extremely common. And it's not hard. There's this extremely simple yes, no test to screen the trades. We just go through. I actually created a spreadsheet. If you attend if you download that ebook that I gave you, I'll send you an invitation to the version of this presentation that I'm giving to our special. Yeah, I know spreadsheets do rock, right, John? To our in-house audience, and I'll show you how you can get that spreadsheet. Yeah. Man, I'll tell you what. I started my trading career as a professional floor trader. I mean, really, that's where I really started as a professional anyway. And as a professional floor trader, I never really used spreadsheets. And when I got off the trading floor, I didn't really know how to use spreadsheets or anything. Slowly, I saw the light, and then I saw the power. And then people would share their spreadsheets with me, and I'd look at the formulas, and then I learned that I could use ChatGPT to create formulas. And now I am a spreadsheet fanatic. And I've got a spreadsheet where you just type in a couple little data points, and it spits out, is the trade a good trade or is the trade not a good trade? And if it's a good trade, I make it. And if it's not a good trade, I don't make it. I love it. Now, also, the opportunities are concentrated in a short period of time. The biggest week of opportunities for the July earnings season starts next week. That key week of earnings is when there are literally tens of opportunities a day. And the week after that, and the week after that, and the week after that, there's literally hundreds a week. But I screen them out. I can easily look and say, nope, not this, nope, not this, nope, not this, because there's a simple yes, no test. And there's even pre-screens before the yes, no test. So I'm not making hundreds of trades. I'm making a manageable number of trades. And for those of you who downloaded the strategy guide and are going to attend my in-house workshop on this, you'll see this story in there too. But it wasn't until I was a trader, like most of the traders attending this training today, in a regular non-professional trading account, that I discovered the power of time spreads for trading earnings. Where you can find the strategy guide, I showed that in the beginning. It's right here, markettaker.com/earnings. So markettaker.com/earnings. And I'll just send that, and I think anybody should be able to click on that. I think. So it wasn't until I was a trader trading on the floor where I discovered really just how powerful time spreads were for trading earnings. And I learned that in like a totally weird way. And this is a true story. You're welcome. So you guys know Abigail Doolittle, the chartress. I don't think she's with Bloomberg anymore, but she was awesome. She was one of my favorite Bloomberg reporters for sure. Classy lady. And really good reporter. And knew her stuff, which not all reporters do. Some really do, but some, you know, they're better at reporting than trading. She knew what she was doing. But one day I found myself on the phone with a producer from Bloomberg Television. It wasn't Abigail, but a producer from Bloomberg Television. And he said, Dan, listen, we want to interview you down on the floor of the exchange. And here's what we want to do. Apple has earnings coming out. We want you to give our viewers a trade on how to trade Apple going into earnings. And I was like, yeah, no pro, geez. And I said, listen, hold on a second. Let me call you right back. And here's the deal. I'd never traded earnings before. That's weird. Didn't expect me to say that, did you? No, this is after I left the trading floor, after I ended my career as a professional trader. So I was a professional trader and never, ever traded earnings before. That sounds crazy. What is this Passarelli guy even talking about? Well, you probably don't know this, but most professional traders have never traded earnings. Most professional traders will not trade earnings. Most professional traders are not even allowed to trade earnings. At the height of my professional trading career, I was in the top 10% as far as profitability goes of money-making traders in my firm. And there were 50 traders. I was in the top 5. I was doing great. My risk manager, Bob, would have let me trade anything I wanted with the company's money, and as much of it as I wanted. I'm sure if I asked for like $100 million, they would have said, no, you're crazy. But I wasn't trading, that I wouldn't have asked for that anyway. I had a lot of different trades going on. I wasn't going to put all those eggs in one basket anyway. So, but yeah, my risk manager, Bob, trusted me implicitly and explicitly and 100% with the company's money. One thing Bob would never let me do is have a position going into earnings. Never. Why? Because you can't predict earnings. You can't predict the direction. I always had to be delta neutral. And he would prefer if I was neutral on all my other Greeks too. But sometimes it would. So I'd never traded earnings before. This guy from Bloomberg is like, give me a trade. I was like, oh crap, this is not what I do. Hold on a second. And I left I hung up the phone. I went over to my trading platform and I started looking for a trade in Apple. And I was like, well, obviously we can't buy calls or puts because can't predict direction. Obviously you can't do covered calls or cash cured puts because those have a direction component today. Too much risk to the downside. Wouldn't do credit spreads. That's just too scary. It doesn't make sense because that's when the biggest moves happen. Wouldn't really want to do debit spreads because I can't predict direction. Straddles were too expensive most of the time, not always, but they were in this case. I was about to give up and call him back and say I can't do the interview. Because for those of you who know me, you know I put my money where my mouth is. If I'm going to make a statement on global TV in front of hundreds of millions of people, I'm going to be talking about a trade that I believe in and have on. That's just how I roll. I wouldn't tell you how to do something that I don't already do and that I know works. So one last ditch effort, I was like, let's look at a time spread. And I looked and I was like, hold on a second. This actually makes sense. And so I put the trade on. I kind of forgot about the phone call. I put the trade on and I was like, oh yeah, I got to call this guy back. And the trade worked. I did the interview and I was hooked after that. And then later I came across some data that I'm going to show you in a second that proved how much this works. When the right criteria are met, and time spreads don't always work. In fact, let's get to that. Time spreads don't always work, but when and time spreads aren't always the best way to trade it, but when certain criteria are met, they can work great. So if there are like the week after next, like I said, there's like hundreds of stocks announcing earnings a day. Maybe 10% of those are worth looking at. If the stocks are under $30, I'm not even looking at them. There's some other screening criteria. But of the 10% that I look at, most don't make it past the yes/no test. So I whittled hundreds down into, single digits of potential trades. Of those that I end up making, about 95% of them are time spreads. Again, there's already like 90% that I just throw out because of certain criteria. But the ones that I don't throw out that I actually end up making, about 95% are time spreads, and about 5% are straddles or other trades. Give me a yes if you're familiar with time spreads or a no if you're not. Give me a yes if you are familiar with time spreads, a no if you're not. I got a no. I got a no. Anonymous attendee, no, you're not correct. when I say I didn't trade earnings, specifically what I mean is I didn't carry a position going into earnings. I still made trades on that day, but I made them in such a way that they balance each other out so that I didn't have a directional position, and tried to make them in such a way where I didn't have a gamma theta vega position a lot of the time. I got a yes. I got a no. I got a no. So we got a lot of no's. Okay, that's kind of what I figured. So let's go over time spreads. And also, anonymous attendee, I specifically said, I don't know, you probably missed my comment, but I said if you grab that strategy guide, that ebook that I gave you, you would get an invite to the in-house webinar that I am giving today and tomorrow, today and Thursday. And that's where I show you where to get the spreadsheet link. So you get that just by going, I mean, I already gave the link. You can click on it in questions here and see it. markettaker.com/earnings. So let's go over time spreads. A time spread, which is also called a calendar spread, or some people call it a horizontal spread, is when a trader sells a call, which is typically at or very close to the money, and then buys another call with the same strike price, but more time until expiration on the same underlying. Or we can do it with a put. Sell a put that's at the money, buy a put with the same strike with more time until expiration on the same underlying. That is a time spread or calendar spread. All right. Sometimes we do calls, sometimes we do puts, and really it matters some, but just do the one that is closest to the money, but out of the money. So that's calendar spread. I said that sometimes, please post the link. BVN, you should be, like, I responded to a guy, you should be able to see that there. But I mean, I'll type it again in case you missed it. markettaker.com/earnings. I'm sending that to you right here, replying to your Q&A. It's also right there. Would buying an option 3 or 4 weeks be just right out of the money, in the money before earnings would be a good filter? Yeah, well, here, Alex, let me just go through the rest of this and you'll see how it goes. Let me first talk about straddles for a second. Straddles extremely infrequently do straddles work out going into earnings, which is very counterintuitive. I already said earnings is the biggest, tends to be one of the biggest moves of the quarter for most stocks. You would think buying a straddle is exactly what you would want to do. But because when I buy a call and a put on the same underlying with the same strike, which means I make money exponentially as the stock goes higher and lose, less and less as the stock goes higher. So, or when it goes lower, I make on the put exponentially. Delta gets bigger and bigger, but the call delta gets smaller and smaller. So I make if it goes up or down either way. You would think, hey, if it's a big move, straddles are great. But here's the problem. Straddles get so expensive going into earnings that they can get overpriced. And even if you get a big move, you still lose on the crush. We'll talk more about that in a second. So this is the breakdown. Now, there's a lot of data here. Don't get too hung up on this. All right? Don't get too hung up on trying to read all the numbers. This is from Live Vol, which is now part of CBOE. This is before they even went to CBOE. I got this actually a long time ago, but it's still really interesting data points. Basically, what this shows is if you sell options before an earnings event, like the short-term options, they decline in value a lot, which is good because if you're short something, you want it to decline in value. But with the time spread, you're short the front options, the shorter term options, and long the longer term options. So they decline in value too, but they don't decline as much. So what that means is if I do a time spread, when certain criteria are met, it can make really good money and consistent money as well, which is such an important thing. If you hear me talking about a trading strategy, it's not some harebrained get rich quick idea. If you hear me talk about a trading strategy, it's something that I've done research on, that I learned the bones of as a professional trader, but then perfected to be done in a retail trading account. So, like I said before, traders buy options leading to earnings, and that drives the price of those options higher and higher and higher. And they tend to buy the shortest term options because they're the cheapest ones. And the longer term ones don't get as expensive, which is makes the time spread thing work. But then after earnings are announced, they either made money on those options or they didn't make money on those options. But either way, they're decaying assets. They don't need them anymore, so they sell them, and that drives the price lower. Now, there are a lot of caveats to this. Like I said, most stocks I do not trade time spreads or straddles on going into earnings. There's very, very, very specific criteria. All right. Now, let's talk about this. Let's talk about the best of the best. The biggest secret to driving consistent results by trading earnings is that we only trade the best of the best earnings candidates. And next week is when this really starts. I want you to be super trained up on this. Okay? There are a lot of stocks that I have over an 80% win rate on trading earnings. And, you know, some that I have less than 50% but some that I have like well over 80% chance, in the 90% chance. Those are the great ones. I just love when, oh, you know, this stock here, yeah, I love trading this one. This one works great. But there's some quarters where it's like, oh, yeah, like I'll just tell you one, Bristol Myers. That's one I'd have to go and look up. I keep records of it. I'd have to look up what my track record is on that one, but it's been pretty good. But it's only pretty good because of the screening. I don't trade it every single quarter. There's some quarters where it's like, oh no, it didn't line up in my spreadsheet. It didn't meet the criteria. Can't trade Bristol Myers this quarter. It is not a strong candidate this quarter. The quarters that it does line up, I trade it, and that's how I get a high win rate. I get a high win rate by being very selective and only trading the best of the best. So let's take a closer look at how this works. So I always put these on the day before the earnings announcement. Okay? And what I do, if it meets the screening, okay? Don't look at this and say, oh, okay, I'm going to do this on every earnings candidate. This is after the screening process, okay? If I trade it What I do is on the day before expiration, or no, on the day before earnings announcement, which means if it's coming out today after the close or tomorrow before the open, I put this on. And what I'll do is I will put on the one that expires this Friday, assuming there's weeklies. I will trade the monthlies too. In fact, the monthlies can actually be great. But I do the one that has the one that expires next with the shortest amount of time until expiration. So like maybe this Friday, I have the 9th here. It wouldn't be the actual 9th. It would be like, let's see, today's Tuesday, Wednesday, probably the 11th, I guess, but it doesn't matter. Assume Friday's the 9th. So I would sell the July 9th 127 calls, which we're assuming is at the money, and then buy a longer term one, maybe the July 16th 127 calls. Usually it's not 1 week apart. Usually it's 2 to 3 to at most 4 weeks apart. I never buy the option with more than 30 days. So I always sell the one with the shortest term expiration, and I buy the one with 1, 2, 3, or 4 weeks until expiration. Never more than 30 days. So this is a time spread. So I put it on the day before earnings if it meets my criteria, and then I take it off the very next day. This is less than a 24-hour trade, okay? So the next day, earnings comes out, you know, whether it's after the close today or before the open tomorrow morning. They have their conference call. And then I have to wait until other criteria are met for me to take it off. And when those criteria are met, I take it off and I sell the time spread that I bought the day before. And this is an example of how this works. And, you know, it's a hypothetical example, but this is a very realistic example. In this hypothetical example, I invest 62 cents a share, which is $62 a contract, times 10 contracts. This would be a $620 trade if I did this. And the next week, sell it, or no, the next day after earnings comes out and the conference call happens, I sell it in this hypothetical case, sell it for 88 cents, which is $88 per contract, which is times 10, $880. So I made 26 cents a share. So I made $260 on the 62-cent trade. That's 41.9%. Not too bad, right? This is realistic. I mean, when it works out really well, this is very realistic. Sometimes it can be better than this. A lot of times it's a little more modest of a profit than this. And, you know, there are times when it doesn't work as well. But the losses are limited and they are manageable. So let's take into account some very important considerations. There are indeed many criteria involved in earnings time spreads or straddles too. I mean, I go through many of the same steps to determine, hey, is this a time spread candidate or a straddle candidate? And, you know, if it lines up as a trade, most of the time it's a time spread. Some of the times it's a straddle. Some of the time it's even something else. But, there are a lot of criteria. We can get very leveraged profits, right? I mean, 41.7% overnight, that's a very leveraged profit. And my win rate across the board is very, very good. I haven't calculated it. I keep a spreadsheet for every quarter of every stock. And I haven't calculated the exact win rate, but I would say at least 2/3 win rate. And the profits are often bigger than the losers. Every once in a while, oh man, you just get a lemon of a trade. But that's few and far between. And so are the 50% winners. Those are few and far between. Most of the time we get a winner, and most of the time it's, 20 some percent or something like that. This is what I have observed is possible. Okay. Let's just say that. I don't make any promises. I don't make any guarantees, right? You can try and trade this and not use all the same criteria, and you can lose in the long run. I don't want you to do that. So I want you to use all the best criteria. But the important thing here is that we're not guessing on direction. You might be very, very good at reading charts, at using indicators, playing breakouts, moving average crossovers, whatever it is. And if you are, that's great. Use those in the way you've been using them. But for earnings, we need a different skill set. Don't use any directional indicators to trade earnings. It's not possible to pick direction. We need a different skill, and that is using volatility. And the good news is it's very, very easy to learn. Okay? Using volatility term structure, learning how to estimate the crush. I mean, that's all in that spreadsheet. Barron says, Dan, are time spreads generally better than iron condors for earnings trades? Can you share insights into relative pros and cons? Thanks. Awesome question. Yes, time spreads are better than iron condors for earnings trades, significantly better. Now, when I said 95% of the time, my spreadsheet will say this is a time spread, 5% of the time it straddles or something else. In that 5% of the time, 90% of that time it straddles. But about 10% of that 5%, it would be an iron condor. Very, very uncommon, but sometimes an iron condor is the best trade. But time spreads are typically a way, way, way better risk reward, way, way more strategic. Their time spreads are typically much better than iron condors in my experience and observation. Vince, in terms of time spreads, how do we choose puts or calls, and how do we choose the strike price? Well, let's talk about that. The strike price, I've got a whole class on this, but I'm going to oversimplify a little bit here. Typically, the strike price is what we call the at the money. Now, at the money classically means the strike price is the same as the stock price. it's almost never going to be exactly the same. So we just use whichever is closest. And synthetically, put spread, a put time spread and a call time spread are identical. So in that regard, in theory, it doesn't matter. But like Yogi Berra said, in theory and practice are the same, but in practice, they're not. So we always need to use the out of the money version. But then there's some times where we have to do a double time spread. There's a lot to it, but hopefully I'm at least giving you some ideas. Vince also said, what is the yes-no test that you mentioned? Well, the yes-no test is all in the spreadsheet. Being this is only a 1 hour training, we don't have time to go into all that. Like I said, download the strategy guide. You'll get an email and you'll see another version of this, and that'll give you some ways to get all the information you need. How do you choose calls or puts? You do the out of the money version of the at the money. All right. All right. So, friends, that is everything we have. If you like what you hear, you can find me on YouTube at Market Taker, YouTube/Market Taker Mentoring, Instagram at Market Taker Mentoring, Facebook at guess what, Market Taker Mentoring, and on X, I have just got my personal one, Dan_Passarelli. And you take out your phone, put it on camera app, and aim it towards that, and just click the little yellow thing that pops up, or just you can find me. Where there's a will, friends, there is a way. Caitlin, you're welcome. And everybody who said thank you, you're welcome, and have a great rest of your day. I will see you next week where we talk about trading a winning credit spread system. Looking forward to that one. Have a great rest of your day. Trade smart, and I will see you next week. Ciao.